Here we go. Let's talk about the difference between Wyckoff reaccumulation and distribution. Now, I have examples of both. Obviously, there are many examples of both, but these are just two that I picked out. The very top here is reaccumulation. The bottom is distribution. Now, one is the pico top of an uptrend before everything goes to Goblin Town. The other is just a pit stop along the way. You have some consolidation. It looks a certain way, and then there's a next leg up. So the big $1,000,000 question is, how do you know which is which? So obviously, this is tailored perfectly for Bitcoin's price action right now. We'll get more into this in a minute, but first, let's focus on the ranges themselves, because I think that's the most important part. Not necessarily like today's price action, but if we can understand these ranges, then no matter what the asset is, no matter what the price action is at the time, this information will be useful to it. Step one is identifying a trade range in either example. So you've got to identify a trade range. Maybe if you use TradingView, your favorite way to do that is with a parallel channel. So you have this parallel channel, and perhaps you see price action kind of ping-ponging around, bouncing around. That's fine. One of the things that it's not so easy to tell right off the bat. You've got to get plenty of time and let this thing kind of flesh out, because sometimes the first few weeks, distribution or reaccumulation, they tend to last like over a month. So people will look at like this under a microscope and they'll say, I know what's happening next, when really they didn't have all this information, after it. It's same with here. The very beginning of both of these ranges are almost identical. There's some very subtle differences, which we'll go over, but for the most part, if you're just kind of eyeball glancing at what price action's doing, it'd be easy to mistake one for the other. Where things get very interesting here is with reaccumulation. This is I'm going to make kind of a generic statement. The majority of the price action, if you drew a line down the middle of the range, you'll see that the majority of the price action takes place on the lower half. So think of it as the market is trying to break down over and over and over and failing. Okay, not only that, but there's many downtrends being broken. In the Wyckoff world, we call these downtrends a creek. So there's a creek like this. That's what is referenced right here. And then there's a jump across the creek, which is like a very strong sign that the market wants to move up. Now, what's interesting about this, a lot of trading is mental, right? This is kind of a counterintuitive thing for many new traders to understand. Why would I see price action that's spending a lot of time, or the majority of its time, down in the lower half trying to break down? How in any way is that bullish? Well, the idea is the largest people in the room are filling their bags, and they can only do that one of two ways. They can market buy and send the price to infinity, because these are like billionaires, even bigger, right? These are big money. Think of the BlackRocks and all the stuff we've seen headlines about lately. These large institutions need to fill their bags somehow. So what they can do is either market buy and price does like this and it's super volatile, or they just set limit bids and they say, you know what, I'm going to be the floor that never breaks right at this, whatever this price level is. And I will have limit bids set there for my $100 million position. The market will start to sell into it over and over and over and over and over and over. And eventually it realizes, hey, we ain't breaking down. There is something here. There is some invisible force at play that we do not have the ability to overcome. So once enough of this supply has been absorbed, then the strong hands continue the campaign upwards. Now I'm using kind of Wyckoff terms, but this should be kind of clicking mentally. You're like, oh, okay. Initially, there's a big move. There's a big leg to get here. And then there's the first round of sellers, kind of a second round, a third little, tepid round. They're kind of lukewarm on their selling, but they're doing it all the same. And then beyond that, there's really nobody left. So that's kind of what's happening up here in this upper range. Okay. If we took a look at where price action spends a lot of its time, if again, we have our trade range, and you can encapsulate the majority of the price action within a range, a horizontal range, not a diagonal range, not an upward slanted range. This is something different. Okay. This is not Wyckoff anything. This is a whole different ballgame. But if you can encapsulate price action like this and draw a line down the middle, and if you can make an argument that the majority of the price action was in the upper half or the upper third, Now you need to flip your bias from reaccumulation to distribution. A sustained campaign of attempting to break up, break up, break up, and failing every time is a sign of the opposite of what took place in here. The invisible hands, the strong, the largest guys in the room, rather than having limit buys in place right here, they have their limit sells secretly up in this level, and the person buying their bags is you. Now, the other thing to kind of keep in mind, usually what happens up in these levels is there's an exchange between strong hands to weak hands. This is intentional. We'll talk about that later. Strong hands to weak hands. And what happens here is the strong hands, whether this is intentional or this is just a product of, the nature of markets, this is usually with some kind of news event that gets people really excited, because the whole concept behind Wyckoff, behind either of these, and what's going on, the psychology behind what's going on here is this. When you are a hedge fund or the biggest company on earth, think of a BlackRock, right? People love to use that as an example. Who are you trading against? You're trading against like me and you, the viewer, and your grandma with her $1,000 who just is like, hey, you know what? I'm going to punt along on Doge. My CPA has bought Doge countless times, and she sends me a message like each time she's done it. It's happened like 3 times. Everybody here is buying with retail money. Even if you have $10,000 or $100,000, that is retail money when you're talking about billion-dollar behemoths, okay? So we as a group are excited, and we're like excited about the future, and the price is here. It's definitely going to double. I have this news, that the reason to be excited. I have this, I have that. And what happens is we end up buying the bags of the largest institutions, and then price falls down. All right. So the big boys were the whole reason. They did all the work to get this uptrend going, and then they took their profit. Then they cashed out. The thing is, you're never going to know that they're cashing out through headlines. You're never going to know it through what you see on social media, right? Because it's the opposite. You think of that Wall Street psychology chart that, looks like this, and it talks about, euphoria and greed. And then down here, it's like everybody's is crying, and you're pulling your hair out and stuff. That is not just because of that's how it feels in the moment. That is a expectation of what happens, and the biggest guys in the room are using that to their advantage.